Nike just posted a 72-cent quarter, and most of that was a one-time tariff refund. Strip it out, and the real number was about 20 cents. So is the world's biggest sportswear brand a fallen giant or a fortress on sale? Welcome back to Wall Street Holic, where we cut the hype and run the same fact-based process on every ticker. Research and education, not financial advice. Nike closed Friday at $44.01. Let's break down whether that's actually cheap. Here's the bottom line. Fiscal 2026 was a reset year. Revenue flat at $46.4 billion, full-year earnings down 3% to $2.10 a share. That Q4 headline of 72 cents, roughly 52 of it was a one-off tariff recovery, so underlying earnings were only about 20 cents. It's a tale of two geographies. North America is inflecting, with segment profit up 14%, while Greater China is still deep in reset, down 17% in the quarter. CEO Elliott Hill's sport offense is showing early proof. Running alone added about $1 billion and gained 5 points of share. Our call, hold, fair value, $53. This is our full scorecard. Every metric that matters, color-coded by whether it helps or hurts. Don't try to read it all, here's what counts. Return on equity is a healthy 22%, and return on invested capital, the profit Nike earns on every dollar it puts to work, sits around 13.5%, comfortably above its 9.5% cost of capital. That gap means Nike is still creating real value. The 3-year revenue trend is negative, but stretched to 10 years and it's still growing. And you're paid a 3.7% dividend to wait. So where is the growth? And where isn't it? North America is the engine. $5.4 billion in segment profit, up 14%. Almost everywhere else went backwards. EMEA slipped 6%, China dropped 20%, and Converse fell off a cliff, down 93% to just $18 million for the entire year. One honest caveat, that North America number is flattered. Nearly $1 billion of a one-time tariff refund landed in this segment, so the underlying profitability isn't quite as glowing as the bar suggests. The recovery is real, just earlier than the headline makes it look. So what's the bull case? 3 things stand out. First, the balance sheet is a fortress. About $1.1 billion in net cash, $9 billion in liquidity, and long-term debt cut by a quarter. Nike can fund this turnaround comfortably. Second, the strategy is landing. North America profit up 14%, wholesale re-accelerating, and running adding $1 billion in sales. Third, durability. Dividends rose 5%, extending a 24-year streak of hikes, so you're paid to be patient. And inventory held flat through an aggressive reset, which protects future margins. Now the bear case, and it's just as serious. Start with earnings quality. Strip the tariff windfall, and Q4 was only about 20 cents a share. China keeps sinking, down 17% in the quarter with no clear bottom. The direct-to-consumer engine Nike spent years building is now a drag, with digital down 12%. Converse is in freefall, down 32% in the quarter. Management is guiding revenue lower for the next 3 quarters. And a fresh headwind is coming. US tariffs step up from 10% to 15% this August, right as margins try to heal. Then there's what's buried in the filing, the stuff that doesn't make the press release. Receivables jumped 26%, but that's mostly the tariff refunds waiting to be collected, not a demand rebound. $2 billion in long-term debt just shifted to current, meaning a bond is coming due soon. Nike's central product and tech engine ran a $4.6 billion cost drag this year. And even the crown jewel wobbled. Jordan brand revenue slipped 3%. If the Halo franchise isn't immune, this reset is touching everything. Here's how we model the next decade. We assume fiscal 2027 is the trough. Revenue dips about 3% in line with management's own guidance. Then growth recovers to mid-single digits as North America scales and China stabilizes. The real story is margins. We see EBITDA margin rebuilding from roughly 10% today towards 16% by the mid-2030s, driven by fuller price selling, fewer promotions, and tighter costs. Just remember, these are our estimates, not Nike's, and the real path hinges on how fast China turns and where tariffs settle. So what's it worth? We ran a discounted cash flow, valuing Nike on the cash it generates, using a 9.5% cost of capital and a 3% long-term growth rate. That lands at a fair value of $53. At $44, Nike trades around 24 times next year's earnings, below its historical range, and a recovered 2029 could justify $58. Flex that terminal growth assumption half a point either way, and you get a range of $50 to $56. Against Friday's $44, our mid-case implies about 20% upside, plus that 3.7% yield. Our verdict: hold with a constructive bias. A trough valuation, net cash, and a 3.7% dividend limit how far this can fall. But an unproven turnaround, a still shrinking China, and soft guidance cap how fast it can rise. So who's this for? Patient investors with a multi-year horizon who want income while a recovery plays out. It's a poor fit if you need momentum now or can't stomach more bad China headlines. The path to the high case runs through China stabilizing and margins inflecting. The path lower runs through deeper discounts and that tariff step up. Our sentiment score, 5.9 out of 10. A quick word on capital returns. Nike sent $2.5 billion back to shareholders this year, but almost all of it was dividends, up 5%. Buybacks were deliberately choked down to just $123 million. Management still has an $18 billion repurchase authorization on the books, but it's throttling buybacks to preserve cash, funding the turnaround and covering that $2 billion debt maturity. Translation: don't expect big buybacks back until free cash flow reaccelerates and China finds its footing. For now, the dividend is doing the heavy lifting. Looking ahead, management expects revenue down low to mid single digits next quarter, with earnings roughly flat through the first half. The backdrop is tough: a cautious consumer, currency drag, and rivals like On and Hoka pressing hard in running. But the calendar has real catalysts. This summer's FIFA World Cup is peak football demand. In August, tariffs step up, a headwind. Come holiday, Nike launches Caitlin Clark's signature basketball line. And the big one, an Investor Day on November 16th and 17th, where full-year guidance and the long-term plan finally land. So, the thesis in one line: Nike is a fortress balance sheet at a trough price, with a turnaround that's real but still unproven. A hold today, an upgrade the moment China stabilizes. Quick disclaimer, this is research and education, not personalized advice. Figures are current as of fiscal 2026 and the July 3rd price of $44.01. So verify live data and consult a professional before acting. What we do here is simple: the same repeatable process every time. An honest confidence level instead of fake certainty, and the bull and bear cases given equal airtime. No hype, no flip-flopping. If that's useful, subscribe, like, and share this with someone who owns Nike. This is a subscriber-led channel. When enough of you request a ticker, it genuinely gets made. Thank you for joining us today. If you found this helpful, let me know in the comments. It clarifies for if this is the content that supports your investment journey. See you in the next episode.
This video is for entertainment only, reflects the creator's opinions, may include stocks they own, and is not financial advice.